discussion tonight on, just kind of a lot of things around what's happening in, the investing in apartments and commercial real estate, overall. And, we're focused on the apartment investing here tonight, and glad to have you all. We'll be getting into the discussion in a little bit. So I'd like to start out. One is, again, I'll do a quick notice or that we're not accountants, we're not lawyers, we're not CPAs and so forth. We're not here to give advice. We're here just to share our experience and what has been our journey as well at times. So what we see, and that's all just for everyone else to kind of take as your best approach as you listen and hear things, not just us, and anyone that you hear from. So there's a lot of good rumors out there. There's all kinds of stuff. So, always consider your sources. So let's go to the next one here. So I'll do a quick, and I'll turn it over here during some of this to some others as we go through, and I'm going to let Trevor, I'll let you go into like a little bit of who Massive Capital is for us, and then I'll go into partnering opportunities, and then we'll turn it back over to Sanjay Schreier and the team and Brad Pickett and talk about the market risk and what's going on and how we see it. And I've tried to leave a lot of time for Q&A. So we got Howard Marks here, as you can see, that's going to lead the way, I guess, as well. So we'll see what Howard has to say.
Hey, he's the best. So
Trevor, would you like to do a quick intro?
Yeah, so welcome. Thanks everybody for coming out. We're at 99, so we're close to my goal of 100. I love it when I hit my goals. Introduce the team Massive Capital. So we have Sanjay Agarwal, Sharar, and Mike Bailey. They're our fearless leaders. And then over on the right, I'm not going to list all of our names, but you can see all of us here. Ones that you'll communicate a lot with are myself, Maria, Jasmine, and then we have a whole team. Brad's going to be doing a lot of presentation tonight. Senate is doing our educational program. So Massive Capital goal is to provide lots of value to people to understand about investing. And we do these webinars every Wednesday night. They're free. We're always trying to provide good content that is useful for everybody. So feel free to invite your friends.
Thank you, Trevor. And we'd like to get started with, give us an idea, put a 1 in the chat or first, if this is your first time on a Massive Capital call, or if you know how many times you've been to one, put that number in the chat. Let's see who's got the highest number as well. Oh, I'm going to turn this one to you, Shariah. Talk a little bit about kind of the value chain, and I'll let you jump on that one quickly.
got it. So for us, the question that we're trying to ask sometimes, what do we buy and how we go about buying it. So as you can see on the top, that's a typical listed value chain, which is on the top left. You have land banking, the land packaging, development, existing asset, then renovation and redevelopment. For us, we buy land for new construction, and we also buy Class C and a Class A value-add assets as well. On the existing assets, typically we lead the way. We have the skill set inside our team, and on the development, we partner with others, or we buy the land and we partner with the land developer or construction companies to do ground-up development as well. So that's our value play. And next slide, you can see as we do those kind of asset types, we also are in the multiple markets at the same time. All the assets in green or light blue on your screen, those are the locations we own assets that we operate. And the light blue is the one that are the ones that we are looking to get into, which is the Arizona and Florida market. So far this year, we closed the land for a new development in Austin area. And that's the first new development play in the Austin area. And then we have 3 properties on the contract. One of them, Trevor will talk about it a little bit more. Amberwood, Warner Robins, and X-Space. So we run our acquisition in terms of a timeline. So we try to bring continuous investable projects for our investors throughout the year instead of one, then a two. So that's how we can operate our process. Right.
There we go. Thank you. And as for everyone that's new, if you had a one in the chat, we'll have a few people sharing their links. Trevor will be sharing his contacts, probably. Brad will probably share a little bit about finding deals. We have besides on our webpage, we also have a link to submitting deals. So if you're doing deals, you get there. So I guess that actually is a good roll into the massive value to partners, and how do we partner with people, and how do we, provide. What we try to do is provide, value across every piece of the doing a deal. So calling that the value chain. And this value chain ties to our educational program as well. If you didn't see it, we will share that with you as well. But the idea is, these we look at as the key components of really operating a deal. They're very high level, but if anybody's thinking, hey, how do I partner? What do I have? What do I bring to a deal? Take a look at this type of a matrix that we have here, and think about where you may fit in, and where your gaps may be, or where you need some help. So we can fit all of these, and we can help people, as they're wanting to do deals or getting involved with us, into our deals. We have opportunities for those as we go through the process. One of our goals is helping people, if that is their need, is to being a GP. And another of our goals, is also just enabling people to understand what is the best way for me to be involved in apartment investing. Maybe I should be an LP for now. Maybe I need to, spend some time, invest some money, learn, get close to some teams, and go through that process. So those are a few ways that we partner. And like I said, Brad will probably share, we have a deal flow, and we have a buy box, and, a way to submit your deals to us, that kind of goes through a quick vetting process. So that's an opportunity out there as well. All right. Current activity, we talked earlier, Schreier shared, we have 3 deals under contract. We have some LOIs pending, and we're underwriting a number of deals. This on the right is just that you get to see the process. So from like this here down is deals that we've archived, and active deals is up here on the top. We're going through 15 or so deals at a given time. So it's a continuous process now. Everything flows into a system we have called Red IQ, which is basically, it lets you load all your data into that, and you can take your rent rolls. You can actually see it, visually what's happening with the rents and the leases. You can put in your in there as well. So quite a substantial tool that is adding extreme quick value for us in our valuation process. We will be launching our fund soon in the next quarter. So in Q2, Q3, we'll be launching the fund and be accelerating that. And we recently have opened up the Massive Capital Accelerator Program, which is basically our apprentice partnering program. It's open. We'll provide you some links if you want to take a look at that, to get started down the flow and see if there's something interesting for you in that as well. It's really a lab, it's come in and work in a lab environment, work on real deals. As we go through stuff, you see what we're doing. So it's more than just online learning. It's real-time activities.
Hey, Mike, do you mind go back to the slide for 1 second?
Yep.
Slide, yeah. Brad, I think this is a good time to introduce Brad, I guess, right? Official introduction of Brad.
Yeah,
That'd be great. So, Brad, please take it away. And this is your show moving forward. So,
Yeah, let's actually go back one real quick. One slide back.
this one.
Yeah, good to see everybody. A lot of familiar faces. So to simplify it for those of you that are newer, there's basically two ways you can get involved. You can be an active investor, and that is as a GP, a general partner, or you could be a passive investor, and that is as an LP, a limited partner. And so really, if you can do both, you want to do both. But a limited partner is where you invest in the deal and we do all the work, and you can come to the meetings, see what's going on. You're going to learn about the deal specifics. And in the meantime, you could actually be looking for your own deal to GP on. So if you want to be an active investor, you can bring us deals, and then you get into one of these buckets depending on what you want to do. So let's say you bring us a deal, you would get a piece of the deal sourcing bucket on the GP if we take that deal and take it all the way to the finish line. So there's lots of ways. And then if you want to raise money for that deal, if you want to possibly do some of the asset management, there's all these different areas that you can fit into and add value and get paid as a GP. And, you know, that takes a little bit longer. It takes a little bit more time to find a deal. So we recommend you start out as an LP, get invested, see how everything works. And then in the meantime, look for a deal as a GP. And then that would come through me. I can go over that process real quick. Basically, you underwrite deals. We have a full course on how to do that through our educational platform. Shows you where to find deals, how to talk to brokers, how to underwrite them. And you take like 10 deals that you go through, take your best one, send it to us, and then we'll underwrite it as well. And then we'll bring you on one of our inside inner circle calls where you'll sit with us and we'll actually go through the deal with you. And you'll see how these guys that have a lot of experience look at the deals, and you'll see what they look for, you know, so that you get better and better as you go. And if we fund that deal, then you get to be on the GP. So just to recap, I think it's best to start as an LP, but in the meantime, be looking for a deal. And if you find one, send it over and I'd be happy to underwrite it and work with you.
Awesome. Awesome. Thank you, Brad. Appreciate that. Let's see. And then let's see, Sanjay. Or no, sorry, I'll go back to Trevor. Trevor, you've been sharing, talking about this. So Amberwood, we're opening this up this is our 506C offering that we have. You want
That's
to talk
correct, yes. So we started this deal out as a 506B and it's transitioning to a 506C. So we can talk about it in this open format. Amberwood is an awesome property. It's a really, really good, strong asset, 1969 asset, but not very much deferred maintenance. Lots of upside on rent. So they can see here on the basics of the deal, 17% IRR, 1.95% on your money, 7% craft. It's a great deal. So just reach out to anybody on the Massive Capital team if you're interested. We're going to be closing early May on this, so you're going to have to act quickly. It's going to fill up. So it's a great property.
Thank you, Trevor. And I just put in the chat again, I just put in the chat. So if you want to sign up, get signed up in our investor portal. You'll see all of our deals. You'll see the past ones, the new ones, just to get an idea of where we are and what's coming out. So this is already in the portal. You can go take a look at it and get ready to invest in that. It doesn't cost you anything to sign up. There's no commitments to sign up. So it just is an opportunity to get more connected with us. So it just asks a few questions. So please jump in and, and sign up in the portal there as well. A few spots left. I missed that. We have a few projects that are under contract and we'll be coming out talking more about those. And, one of them is a 506B. So if you do have a relationship with any of us, you want to talk about a deal that we have under contract, go reach out to one of us that you know. And the other one is the X Space, which is coming up soon, which is a new development in Houston. It's going to be in Houston. It's right inside of the loop near I-10 and 610. So it's a great location. Paul Sink is leading that with us thanks Paul for bringing that along with us. And I think we'll go ahead to the main presentations because we're about 6:20 into this, 6:23, Shire, Sanjay. So turn this over to you guys so you can leave a lot of time or little time for some Q&A and maybe do some round robin during the presentation as well.
Of course, thanks, Mike, and love the team, everybody. Great. So the big elephant in the room, this Jay Gajavelli foreclosure that kind of rocked the multifamily world. So just from a facts perspective, you know, Jay looks like a DFW resident, but 3,200 doors in Houston, about $230 million worth of loan that got foreclosed by Arbor Trust, and they took ownership at the beginning of April. And after that foreclosure, it got sold to this fundamental group. It's called the fundamental group for 32 million below the loan value. So what a great deal for those guys, I think. But one of the reason we are bringing this up, you know, all the LP investors lost 100% of their investment in this deal. And, you know, so those are the facts, right? Public facts, you know, everybody knows, heard why it happened, could it have been stopped, and, you know, how did it get to this extreme, and all those things is what we're kind of discussing and bringing up here. You know, there are a lot of speculation about things of Jay and his company, and I've seen all kinds of things in the forum. So, you know, yeah, some of it may be true, may not be true, but we don't want to speculate, right? We want to stay with the facts. So fact is these are foreclosed. The properties, you see the rats and roaches on the right-hand side, that comment, news headlines been there just because these are the some of the deep class C, maybe D properties that the company strategy was they were buying and doing these. There was highly levered, these were highly levered, so 80% plus leverage was there. And the facts we know, the interest rate. So most of these properties that were foreclosed were bought in the second half of 2021. And I think there was one that was bought in beginning of 2022. So, you know, taking a little bit of a step back there, if anybody who's been in the real estate game in the last 10 years or so, you know, all they have seen is this low interest rate environment. And it feels like a decade. 1 decade is a long time. You know, you look at that and you say, well, interest rates will never go up. You know, I have a lifetime that the interest rates will not go up. So, you know, these were bought in the end of 2021, early 22. Interest rates were in the 3.5% range, variable with no rate caps and no fixed interest period. So that right there is a big key that, you know, no plan, no nothing. In addition to that, a couple of the facts that we know, the properties did have just around $2 million worth of unpaid labor claims and liens that were floating around for between these 4 or 5 complexes that were foreclosed on. So, you know, and that, you know, our kind of the guess, the speculation is, you know, yes, a lot of issues were there, and how close, how involved they were there, and what made them to conclude that, hey, foreclosure is the best route to go to and let it foreclose, right? So those outstanding labor liens and claims could be a big part, but again, a speculation on our part. We don't know for a fact that's the reason it went to foreclosure, right? So accounts payable, which is a key part of these businesses. So yeah, that's kind of the big deal, rocking the world. Again, one of the reasons Mike started with the disclosure is, we don't know these future, right? Everything that we put out there is future projections. So anyway, so that's out there. Schreier, you want to add anything on this slide?
No, this is good. I mean, hey, this is almost like, I know, looking back, everything is clear, right? And hindsight 2020, but we'll try to take an academic, as we said, we tend to be a massive capital perspective. We tend to be a little bit more academic buyer. So we'll take that as a case study and we dissect it a little bit analytically and academically, and then we'll come back and say why we think the project failed and why we think there's some of the indications were already there, right? Back to Sanjay, if you want to go to the next slide and walk us through the cycle, that'd be great. Yeah.
I wanted, as you get into this, I wanted to thank, I looked back through the chat. That's amazing. We have some really great, we got a lot of new people here with us tonight. So glad to have you all here. Continue to connect with us as we go through this. So go ahead, Sanjay.
Yeah, and I see some questions in Q&A and chat. So feel free to keep typing the questions. If you can answer, somebody will answer. Otherwise, we'll leave that time at the end for Q&A. So from a cycle perspective, we got to be aware of this cycle, right? And this is a nice little graph, how it starts, and we kind of put it there for 2021 coming out of COVID, which is kind of the optimism that was there that, hey, COVID could not even shake the world of real estate. If anything, it helped and made it go up, right? But really, that optimism has been there since we came out of that 2007, 2008 period. So those 15 years. But the cycle is there, optimism, thrill, and you do one or two deals and you're excited and you keep doing. And it's really when you start to go down, right? You don't know how far down it'll go. And there's the initial denial, and then the fear and desperation. And what do you do in those phases is a key. And of course, you hit the bottom line and then you come back up again. And if you can survive that bottom line, then that's there. In our opinion, as the Fed started raising the interest rate in 2022, that kind of was the peak for real estate there. And with the aggressive interest rate increases, will it be end of 23, 24? Will it extend further to 25? Its jury is still out there. U.S. economy is doing great, so that's where 23, 24 is definitely there. And then where do we land on this curve? When would we land on that curve is still out there. Schreier, you have anything to add?
Yes, no, this is good. I'll talk about the one on the right side as you kind of go through.
Yeah.
So thank you, Sanjay. So, I mean, that curve I think almost everybody here has seen it. One thing is that curve we're looking at on the book, on a piece of paper, I don't think is going through the journey, right? Even though the curve has a nicer slope, but what happened, it was a straight fall, right? From last year to this year, that was a nosedive from euphoria to about depression almost. What happened, especially on the multifamily side, because of the interest rate quite doubling, right? So that's the cycle. And now on the right side, for next 10 minutes or so, hang tight with me, and we'll bring you back. We're going to go into finance a little bit. On the right side, it's an X and Y axis of risk and return, right? As you know, the most of the real estate deals that we do, if I take a fixed rate, that has typically the lowest return. Then we take a floating second one, a bridge, a third one, and a non-recourse bridge with the no rate cap, with the pref equity. And that is the biggest, most amount of risk with that most amount of return, right? That's the typical curve. And as us, what we call it, the massive perspective, we buy risks, and we don't buy properties, we buy risks. And it is our role to understand the kind of sort of where the market cycle is, and then put the financing around it, and then go buy the property. Where typically we'll go buy the property and try to find the whatever loan is available and trying to ride the market, right? Again, we're not saying we can time it, but we can say we can be closer to the market as we make our decisions, right? In this particular case, for this project, that's what happened. Is this project has a low, I think low around 3% interest rate coming in, had no rate cap, and had a big pref check. And that was on the top of the market. So what happens on the top of the market? I took so much of the risks. If the market goes sideways, I have nothing in the project or nothing on our side to pay up and go through the downside curve of it, right? And again, 1 year, 2 years, it doesn't sound a lot, but it is a lot. It is not a lot, right? When we're in last year around this time, all we know something is going to happen. We just didn't know what's going to play out, right? So we took a different financing position compared to most of us that were in the business. But if I look at this project, he bought quite a bit. He returned quite a bit of money. And all the money, or majority of the money that we understand it now, it's because market gave it to him. And when market gives us a gift, that's a gift. It's not a business plan. And I think that's where that thing happened. So going back to this project that we're talking about, there was a big, large pref equity check, and that was institutional check. And underneath that, that was the agency debt. There was a floating debt from Arbor, and that floating debt did not have a rate cap. So when he picked up the project, market took a turn right away. And I think based on what I heard talking to some of the other folks, within the first quarter, he wanted to default. So the project didn't have enough money to pay for the debt within first quarter of it. So even though we heard about it now, it's in the process cooking for almost 9 months or so. And the team who bought the asset at the foreclosure was the team who invested with him as a pref check. And that's what the swap happened. So yes, partnerships are there, but the same thing, how we structured the deal has big consequence depending on what cycle we're at, right? So that's just to kind of share. So back to the point, it's yes, every cycle it's a buying cycle, but it's not the way we buy. The way we buy it in a down cycle is not the same. It's not the same way we buy an up cycle. The stuff that we buy in up cycle may not be a good fit for down cycle, right? So we just have to understand at least the jive with the market and be patient with it and take a shot about being closer to the market, right? So point is, the way he bought the property today on the top of the cycle, it wasn't optimal at all because of the rate cap. But today, everybody should buy asset based on the structure he put in there a year and a half ago, because we are on the bottom cycle. Interest rate is high. It's going to go up a little bit, but not a whole lot. So if you buy a bridge debt, fantastic. We are paying top of the market. So market gets better from here. If we do a floating rate, it's great, because we do know a year and a half, 2 years down the way, rate is coming down. So, but again, the process, the point is, the way he bought it in 2022, that was a block to the death. But now that makes sense. So it's for us now understanding the market cycle and then put the financing around it. So if you go to the next slide, Mike, this is where I kind of took it down. Now, context, about 3 webinars ago, we talked about the market risk and project risk. So I tried to put that back into that in a framework. So every project that we do, we have 2 kinds of risks. One is the market that we're not in control of. Other one is in the project that we're in the control of, right? Someone asked a question about the asset management and P&L management. This is where asset management comes in. So for this particular project, there was a market risk, which is the interest rate. I think I did some Googling from a Reddit. Someone posted he had a 3.4%, went to 8% right away, and he did not lock this rate. So his interest rate payment on a $200 million asset instantaneously doubled, and that's a big one. The other one is the economic condition. As you know, Houston market, 3 quarters ago, the lease-up rate started going down, and the retention rate went down. So that's not a good time to increase the rent. So he could not increase the rent fast enough to pay for the interest payment amount that went up. on the project side, on the investment strategy, and he's known to pay for top dollars. Again, market gave and made him money, so I understand. So he paid a very high price, and he betted on the market even going up on higher. Right? He didn't act according to the market cycle, right? Knowing, after someone has a 9,000 doors, and we expect them to understand the market a little bit more, or the team should have a little bit more know-how to see, I have an interest rate at a 3%. I'm buying a $250 million worth of assets. I should cap it, because I saw COVID, I saw inrush of money, and money has to go to the system. That causes inflation. After inflation is my deflation, right? It's an academic way of taking a look at it. So that was a miss. Financial policy, didn't have enough working capital or liquid funds. Project went upside down in 3 months and 4 months, right? So he just didn't have, and I believe that's not the first time he has done it. He has done quite a bit. We bought an asset from him last year, so we kind of sort of know how he keeps it. So now it's much more clearer. We felt like his financial policy, his team's policy wasn't healthy. Operational strategy, based on some of the digging and other senior players that we've spoken up and some of the assets that he owns, we looked around. It's revenue, his operating strategy execution wasn't there. Most of the projects that I talked to, other LPs, cost overrun was there, and less cash flow was there at the company level. The last thing is the management style. It's back office operations are very non-technical. For us, what we call it is that it is, and I mean, everybody must invest. I mean, if you ask me, everybody should invest in apartments, but everybody must not be an owner operator of apartment. It's a tough play. It's running a company, and here's one of the way you take a look at the growth pattern or the health of an organization by looking at their back office. Are the finance heavy? Are the technical heavy? Are the analytics heavy, or something like that? Jay has been operationally very lean. You can go to his website. You can see 3 folks from Philippines, 1 person from Houston, and him, and everybody else is 1099. And that is not a recipe for running a $250 million worth of assets, right? So putting all together, again, hey, all the risks stacked up, and it would have been okay if the market would have gone higher. Since the market went sideways, everything fell off. So that was our view of looking at, how this project failed. It was stacked up everything. It worked out up until 2022. And then 2022, when market hits it, it really hits everybody. Like going back to market risk, it doesn't matter how good of a player we are, right? When the market hits it, it hits it. It just does it. And everybody will get a fair share of it. And some of us will make it through 2023. And we are communicating to our investor as such as well. But look, it's a market. We could execute the business plan on the OpEx, on the CapEx, on the revenue. But when the market hits it, just be patient and go through the cycle and come back on the other side of it. So that's slide number 14 is that's our analysis of this and a failure of it. So point is buy, but don't buy the way you bought it on a different cycle. And then next slide on the 15, it's a little bit about us.
Sorry.
Okay.
Keep scrolling. Sorry.
On the far right, as we shared on the right side, at the bottom right side, we believe we're at the bottom cycle of the market. We're going to stay there for another year and a half or so. The office is coming, hotel is right behind it, and multifamily is like a third one, which is the third strongest asset that is holding true. So one of the best thing about the multifamily is that the pricing is based on the income, right? As long as cash flows, you're fine. Market could go up and down, no big deal. As long as I don't have to sell and I have enough cash to pay for the bills and continue with it, 2 or 3 and 1 or 2 years out, we should be okay. So the point is, for us, perspective is that hang tight, hunker down, run through the business plan, and when they turn, then you optimize and maximize as you go. So that's our position, and then we acted on that. So on the left-hand side, on 2022, I'm kind of sharing that when we bought one of our assets, we bought 8 assets outside, 7, 8, 9 assets outside Massive, but I'll talk about 5 assets. Those are big ones. One, we bought a floating debt. That was April last year, but we had a rate cap for 2 years. So we thought market's going to go crazy, whatever craziness happens. We thought 6% was a good number, and we ran it. Now, full disclaimer, I come from finance, Sanjay come from finance, we have another finance, and we have two other folks from the finance background. We thought we got it. We assumed last year, this time, that we'll hit the rate cap 6% in 2023, Q2. But for us, rate cap happened in 2 months. So we capped it, we missed the time, but project is fine. And then afterwards, the market was going crazy, everybody kind of sort of sheltered down, but we went in and bought 4 more assets, but we bought them on a recourse debt. We bought them on at least a 7 years fixed, and we're just fine with them. 2023, we bought fixed bank debt, fixed agency. We bought a floating debt with a market rate, which is we are top of the market, bridge debt, no issue at all. And then we built a team. We put a team for investor relations that earlier we talked about. We have 4 full-time real estate investor relations team. We put a team for acquisition. Brad leads the way. Behind Brad, we have 2 more folks. We added tools to it. We bought institutional grade tools in it. Rate IQ is one of the best tools you can find. So we built the investor relations team. We built the acquisitions team. Now we are putting a team for operations for the finance. We have 2 folks already. We're trying to get 2 more. So it's a 4-people team as we grow our team, right? So its point is, when you look at investing, look at the project, look at the returns, but double, triple, quadruple check the team who's running it. And you start from the back office, and you work your way to the front office. That is who are you talking to, right? Especially on existing asset class, $100, $200 million asset under management, you got to have a back office to indicate that, hey, you are spending enough time for that particular project to execute the business plan.
Yeah, and can I add something here,
Sanjay,
Shrek?
yeah, Sanjay, Mike, and Brad, join in. So.
Yeah, so I'll just add this, the first one here that Shrai listed. When we were going through that project, that rate cap was expensive. So our interest rate was 3.25%. And as we were going through this, so many times in the team, somebody would bring it up. Do we really need that rate cap? Interest rate's been low. They will not go up, right? But it's not a option at all. And 2 year is a very short period of time in these commercial deals. So we stuck with it and got it and shelled out whatever $200,000 plus for that rate cap. And sure enough, it's paying off and it's in the money. So if we exit early, it pays back, right? Number one. Number two, we are 1 year into it, and we're already saying, hey, look, I got to do something. I don't have time left. We have a whole year left, but it's like, oh, we don't have time left. We got to do something. And there is a little plan we have that if it goes beyond the rate cap 2 year expiration, do we have enough cash, right? So that's those are subtle operator related things that are hard for an LP investor to kind of sense or get out from a deal presentation, right? So, but once you ask the questions, it's a key thing to look at the loan. Always look at the financing terms. A lot of these deals, yes, there is the operations play, but these are a big financing play on these. So there is that. And I'll make a quick comment on number 6 there, and then Q&A also with Brad and Mike. It says we are placing a team for operations FP&A, right? Before that, that's just because we're getting just north of $100 million assets, but out of that 100 million for $50 million asset, we have a big partner, Hampshire Capital, who's doing majority of the work on that asset, right? But before that, we've been full-time on all of our assets, and every day, every second, we've been dedicated. And now that we're getting a little bigger, we're looking to put that financial analyst to say, hey, this is my monthly operational expenses. This is the cash we need to have. This is our risk. What if our occupancy drops this much, or rates in the rental rates drop? what is the cash position we need. So that's we know that right now, right? But we're putting a team in place now because we're getting a little bit bigger. So we realize that Schreier, Mike may not have time to look at that. And we don't want to miss that on a quarterly basis. So having a person to give a direction and having that line of sight is a big key. So I'll stop there. I know Mike, Brad, if you have anything to add or open to Q&A.
Yeah, no, thank you guys. Thanks again. And again, I'll just, emphasize just the piece of following us and follow along as we go, on the apartment, multifamily, commercial.
Hey, Mike, I think you broke out.
It's Class A apartment, given a little tough time.
Okay.
Hey guys, I'd like to add something. So I think it's important that we talk about why right now is a really good time to be buying. Because when we look at these assets and we have to underwrite them at 6%, or if it's bridged at 8%, and we can make those numbers work, what that does is compresses the price. And if we can make an asset work in today's market, that's going to set us up really, really well for the future. So even though we've gone through all this, this isn't the time to sit and be scared. This is the time to get in and to go after it. And that's why we're aggressively going after deals. But we're underwriting them. We're forced to underwrite them at high interest rates, which means that when rates stabilize again, looking at history, we can see that they're going to stabilize at some point. We don't know when. That means we're going to be sitting really well, and our projected returns will probably be higher than what we even expected. So I just want to emphasize that right now is a great time to be buying.
And so thank you. And Mike, let me know when someone left a really good question, which is anonymous, but really good question. If we're Apple's way, how would you run that differently? I had a smile on my face. So side note is we also do residential between me, Ms. Sanjay, and Mike. We buy at a yearly basis hundreds of single family and land tracts and other stuff on outside of commercial. One thing they're just saying, you don't flip house when the market is hot. You just don't. You stay on the sideline. Same goes for the apartment. I would not buy a Class C on a top end on the market with the floating date to begin with. So that question is this: don't buy it. Don't just do it, and because the market is too hot for you to make any sense. Yeah, I understand there's a MAC fee putting deal together. I have to do it, but again, you got to be aggressively patient, right? Just write that thing, buy different. Our first deal, 2022, it was a $19 million deal. Yeah, we could have bought the next $20 million deal right after, but we didn't. We went down to $3 million right away, then $5 million, then $7 million. We took a different approach compared to most of the folks did. So just to share, right? And something is better not to do it, right? Last 6 months, we're looking for Class A, coming out the CEO program, what everybody's saying, why are you looking for a bridge debt? We are looking for a bridge debt because we're on top end of the market and everything is on the other side of it, right? And we are shying away from loan assumption that is 3% and 3.5% interest rate. And that's because on the market cycle that we shared, right? So
yeah,
back to you, Mike.
I will buy a 3% loan assumption, but I'm gonna do my underwriting with a 6% interest. And that's the fallback of what Shrai is saying. If you look at a loan assumption at a 3%, but guess what? When you're going to exit in 3 to 5 years, interest rate still maybe 6%, and you're going to have to sell at the price with that pricing, right? Not to mention any the prepayment penalties or yield maintenance. So, but yeah. So, would love to hear some questions from the audience.
Yeah, please. I was going to say, there's put your hand, put a hand up if you want to, ask a question. Let's be interactive here and get involved a bit more. And I forgot I was supposed to take off sharing the slides for a while so we could all see each other. I see a lot of people that I hadn't seen in a long time, and I see a lot of people here that I saw this weekend as well, that while I was up at the Sumrock thing. And great to see y'all joining us tonight. So we got a few people already. Reginald, why don't you go ahead, please?
You may have to unmute, Reginald.
I tried to. Reginald, you there? Maybe he's.
Okay, why
We'll
don't
go
we
to
give,
Balaji. Balaji, you want to go ahead?
Can you hear me now?
Yes.
We can, yes.
Okay. Yeah, my question is, see, for some of the deals I did as a GP or in general as an LP, right? The business plan you see 6 months or 8 months back versus now, there should be a change in my view, because the original business plan may have some improvements, assuming the rent will go up, all that, right? But in this environment, maybe the cash is king. So what are the changes that you see? Typically, maybe you don't spend the cash on the unit upgrades, but still try to make sure you have the cash flow. I'm trying to see what is your opinion on that aspect, in terms of particularly if you're in a big deals like 60 million, 70 million, or 500 plus apartments. I can repeat my question.
No,
If it
I
is
think we're viewing it, thinking, so I'll let,
Got it.
I
So-
see,
so
I
the
see the
question-
lights coming in for Schreier, so go ahead.
Okay, so it's a loaded question, and it's a very good question, right? Let's take it. Let's say we have a $50 million deal and we're running the business plan, right? So typically there are 4 places money is going to be spent. Your OpEx on your tax. I mean, that is, typically that we can't forecast it, right? Tax increase, insurance increase, and your run and maintain. And the last one you have is your CapEx, right? So when depending on how we bought it, if we bought the property with a fixed interest rate and a fixed payment, then we know our debt payment is pretty fixed. Then my exposure is tax and insurance. And if the revenue, depending on, is that the value add where I have to increase the rent, or it is that I have to increase the rent to be on the top end of the market for me to extract the benefit. So if the business plan is, the property is underrated, under rented, it's just fixed to catch up to the market, then cash flow should be okay. Your issue that we're going to get into is the retention of the customer. So we have to manage really, really strongly on the lead flow or deal on all the closing on the people are walking into the property. Because when the market turns, everybody will give you a discount. Then keeping my customer, keeping the community is the biggest thing to continue the cash. On the other side, since market is tough, what we should do, not let go of the cash on hand, just reserve a little bit just in case. Sometimes things come from sideline that we have no control over it. So all in all, I would say look at the P&L from the bottom, have healthy amount of working capital. If the working capital assumption was to keep the money 3 months, keep it for 6 months, and communicate with the investors, minimize the CapEx, but spend considerable amount of time building the communities to make sure that people stay, they live less, right? There's a rule of thumb that we use. 1 month of physical vacancy is 3 months of economic vacancy. And if you can reduce that, that'll be great.
Got it. Thanks, Shannon. That's a good answer. One follow-up if I can.
go ahead.
Yeah. So this is regarding the investor communication, right? Other than the monthly bulletin you send typically, which probably is high level, maybe with a little bit of more details in the vacancy, all that, right? What else we can look? We can probe and give some KPIs. So basically, investors are a little bit scared. You want to make sure whatever bad news they're seeing, hey, if you're worried about that, okay, I'm giving an update, maybe oral update or whatever we can, right? In 2 weeks saying that, yeah, it's not happening in this, right? I just want to make sure, have your thought, get your thoughts on that in terms of the communication with investors.
I can give you my opinion to it. To me, it's, as you know, it's like let me give an example. Think about our house, right? Mom, dad, kids, and family members. If one of us gets angst, we tend to pass it on to somebody. All of a sudden, things could be simple, but just because I had a rough day, everything gets stressed out. So it is our role to balance the equation out, right? If
Right.
I call my investors at a weekly basis, I'll freak them out just because I call them on a weekly basis. Doesn't matter how many good news it is, right? And so we debated about it, how good, what KPI on what it is. So our thing was strike the middle, that have a monthly communication all the time, and open the time. If anyone has any specific question, want to know, give us a call. We're happy to sit down with you 10, 15 minutes and walk you through, right? So we left our communications whenever we send out our passive investor communication or anything else. Our investor relations, our philosophy is that we have a dedicated focal point for assets. That person knows everything about the project. If you have some burning question, reach out. We'll get you an answer, as soon as you can.
Got
Other
it.
than that, it's a monthly communication. That seems to be a good one. And then we are leaning towards a quarterly webinar in terms of projects. Now we are debating, do we talk about one project or do we talk about openly all the projects?
Yeah.
Right?
Makes
And Balaji, one key question I would ask if you're on some other deals where you're not active is, what's your monthly OpEx and how much cash you have? Right? I mean,
Got it.
that's the bottom line. Of course, watch the balance sheet a little bit to make sure it's not accumulated on balance sheet liabilities, but just the monthly OpEx and cash. That's just those two things, two questions is a key, which we, from our side, we watch that like a hawk, like, hey, I don't want to be running out of money. So, yeah.
Right. Thanks, Sanjay. I think both Sharia, I think those are great inputs. I think making sure it's run properly, right? And I don't know if others have raised. One last question is, do you see advantage in this market with the vertically integrated operators versus non-vertical, because they have everything in-house, including the property management? Maybe they have better control on costs. Is that an advantage, do you see, or no?
I can answer that, guys, if somebody wants to
Yeah,
chip
go
in.
ahead, Sanjay.
Yeah, I think it can go either way, in my opinion. If you got everything, are you really getting the benefit, or are you really split across multiple directions, right? And then you're not delivering anything. Plus, if you got it in-house, is it a fixed versus a variable cost structure? So if it's a fixed cost, you're stuck with it. You can't fire your contractor and get a new person if they're not performing, right? You can't fire the management company and say, get the hell out, or I'm going to take over, or bring somebody else, or whatever. Versus what you pointed out, right? I mean, if you're doing it well, it's set up right, and if you got the right the people, right structure, right processes, yeah, it can deliver a huge value because you have control, right? But otherwise, it could go really negative too, also. So I would say, it really depends.
Makes sense. Okay.
Sure.
Thank you.
Sure. Let's go on to some other questions, I think, because we got plenty of people. And I wanted to actually, Jasmine, I don't know if Jasmine, are you able to?
She's driving.
Oh, she's driving. Okay. We'll let maybe Trevor, I'll let you answer a question. I was gonna have Jasmine, she's like one of our leading 401k people. Trevor also is, and we do a lot of work with Quest Trust. Trevor, you want to answer Lucy's question about how can we use 401k to invest? You're muted, Trevor.
Sorry, I've already sent her a note to book a call with me, but it's very easy to set it up if you've already moved for your job. So if you have left your job and you have money in any retirement fund, you can move that over to self-directed, and you can use it to invest in any real estate deal. It's not complicated to do. Happy to help walk you through it. We have several that we use that can help get that done. And a lot of our investors do come, and I've got 7 investments through mine myself. So.
And I noticed as well, I see now as well, Brad reached out to her.
Yeah, we are all chasing everything.
So
we're on it, Mike.
Yeah, no, but it's good to talk about it.
Yeah, no, it's really good. And it is powerful. There is nothing more fee heavy than retirement plans and life insurance plans. There's nothing more fee heavy. They make all their money on fees, and fees mean you don't make money. So, yeah. So I think Reginald, I did unmute you for your
Hold
question.
on, Trevor, hold on a second, sorry. Reginald, you'll be up next, sorry. I just wanted to address one other thing, because I saw something Brooke shared, and we actually heard something really interesting on last Tuesday at our meetup from one of our CPAs, that you can do a quadro. And so usually a quadro means like, hey, I'm getting a divorce and I'm splitting it out in my 401k. But you can also do a quadro actively or proactively, or however you want to say it, and split out part of your 401k to your spouse out of your own 401k and your business that you're working in a W-2. So you can actually put in place a quadro to separate out funds if you.
We had a long discussion about it.
I
So
think Mike retired.
we took a break.
So
It's
my,
You froze for
sorry,
a
my
second.
internet keeps going down, so I'll turn it back over to Reginald.
All right, I think you should be able to unmute now.
Hey,
Awesome.
how's everyone doing? Can you hear me?
We can.
Okay, awesome. Appreciate all the information you all put out. So I'm a fairly new operator. I closed on 96 units last year, but this year I'm looking at a deal now that cash flow well, and there's a way to up rents and lower expenses. But there's opportunity to assume the loan at a 3.98% interest rate. And I just want to make sure I had clarity, because I didn't think about this. Are you saying underwrite, even though you're getting that lower percent, are you saying underwrite it as a 6% because rates are definitely not going to go back to that, course, anytime soon, or maybe in the, future 5-6 years? Is that what you guys were saying earlier?
Something in the line. Let me explain. So let's say your business plan is you want to sell the property in 5 years, right? And today, as you're buying in, your pricing, your NOI is dependent on that interest rate that you have, low interest rate, right? But when you sell it to me 5 years from now, I'm going to price it at a 5% interest rate. So you have to work for free from now to get your property NOI up to my price point, just because. And then you have to work more to make sure that rent goes up enough for you to make profit or to create value out of the thing. And that's the slippery slope. That's what we say when you look at the interest rate, you make sure your rent increase is big enough. So not only you can cover the NOI for the higher interest rate, but also you cover for your profit. So that's one. And then second thing, you check, when does my rate expire, right? Is it 3 years or 5 years or 6 years? If you can have 5+ years, have at it. If it's anything less than 5, worry about it.
Gotcha. Yes, it's a total of 7 years.
Okay, then it's
That's
fine. You got
left
a
on
long
it.
time. Yeah, it's long time. Run with it. You should be okay as long as you see a clear path. As long as you're buying a value add that has decent amount of spread between as is rent and to be rent.
Got you. Man, I really appreciate it for the information. Thank you.
Hey,
Awesome.
Reginald, send it over. Let's take a look at it.
Any more questions?
Simon had a
has a
question.
hand
Okay.
up. Yeah, I have some questions. All right, I finance a lot of people around the country, so I'm even working with the 500 million plus AUM guys, and there's no silver bullet right now. So everybody's freaking, just like $50 million players versus $500 million players.
Yep.
So having said that, I do see a clear trend of even banks trying to work with a pricing model right now. I've had few lenders recently came out and said, you know what, we're pausing lending for now. Even looking at the the treasuries and whatnot, this volatility is not making quite sense. So we're just gonna go SOFR based, that we're going to figure out how to price these things, and nobody has figured out what they're going to do. And I've seen a number of even credit unions kind of pausing lending at the moment. Just a thought. So And given the rate, I just don't see rate going anywhere much until perhaps latter part of next year, perhaps. So having said that, if you're pricing in enough reserves going into a deal and raising, and you're offering 7% pref, are you going to keep that as an active pref? You may run into some cash troubles unless you raise the more you raise, obviously it's the pref situation. I see that as in a matter of speaking, if you think about it, if you raise everything as a equity, then you're getting 100% financing, right? So are you like still paying as an active pref versus are you offering some investors, hey, listen, we'll have 7% pref, but we're gonna have like a 3% of it will accrue versus 4% active? And does that make you want to do more of things like maybe we'll look into a little bit longer horizon with the market conditions? So does that make you want to go more a cost seg up front, a little heavier, or things of that nature?
That's a very good question, and that's very loaded question. So I'll give you two kinds of answers. One, to me, pref in general, if I talk to the institution, it's a very active pref. So if I get a pref check from the institution, my negotiating will be less now, more later. That gives me the breathing room. If it's a 12 pref, hey, can I give you 3, 4 now, 7, 5 now, 7 later, or 4 now, 8 later? I'll make you whole, but that's later, right? That's the institutional pref. When we talk about the LP investor pref that we call, that depends on the project. And we'll be upfront with the project. I mean, for the LP investor, the pref bias is that, look, after the debt, you are the first one to take the profit, and then it's us taking the profit. So you are protected. If any profit were to come in, you take the first shot at it. So that is the view of it. So we have done a project, Georgetown. It's a land play coming in, hold for 2.5 years, and you get out. We did that one in 7 pref, and what we mentioned to the LP team, look, you're not going to get the cash flow, but the first 14%, first 17% of the profit goes to you before anybody gets the money. So look at that. And so that's we kind of designed it. So it's depending on institutional pref versus an LP pref. We'll design it such a way that creates the breathing room for the project, because ultimately project has to be healthy and has to be delivered, right? We're not going to do any project where under the name of making investors happy, the project is very tight. It's the other way around. Project has to be good. Then we design the whole capital stack. Then we design what the pref needs to be, right? 2 years ago, we did 8 pref. Last year, we did 7. Now we're doing 6. Just to create breathing room as you kind of go through, right? So it's a floating risk. So that's how we are looking at it. And that's how we look at our capital stack. That's how we do the optimization of it. Not all projects are made the same. We'll pick and choose whatever the best for the project.
By the way, I forgot to mention one part. I'm not seeing too much of a cap rate decompression at this point. Are you guys seeing some more on your end, since you probably get a little bit more deal flow on your end?
Brad can talk about the deal flow. So we have like, I don't know, 15 to 20 deals we underwrite actively.
Sure.
We have seen cap rates to increase. In Arizona market, we have an offer out. It's 5.8 going in cap rate in Arizona market. Class C, 6, 5.8, 6 all day. Upside down deals, a lot. And it's just there. And as long as, cap rate is there, but it just depends, But yes, definitely we have seen cap rate increase. Back to you, Mike, Trevor.
Awesome, thank you. So I know we're
Thanks,
we're into the happy hour, even though these aren't all that happy questions, but normally we do for 1 hour and then we hang out and answer questions. So I think obviously this is a topic with a lot of questions. So anybody else have any more?
Please, those are good questions. To me, those are happy
no
questions to
great
ask.
questions
So,
tonight.
yeah.
Thank you.
Yeah, great questions.
And we hit 115 people, so I feel fulfilled.
Someone was saying
Reginald
something.
again. I think
Okay.
you should
And
be able to
again-
unmute yourself.
Yeah. Go ahead, Trevor. Sorry.
Hey, I have one last question. Due to the fact kind of how I guess the market's doing and people scared, and you're kind of saying articles like this with multifamily going to foreclosure, are you guys finding a hard time to raise money, or are there people still out there trying to, put their money to work even in this market?
Mike, you want to go for it?
Yeah, I'd say that's another loaded question. But no, we did a raise at the end of the year through the beginning of this year, around 9 million and in about, 40 days or so, 45 days. And then we followed up with another one that was around a 1.5 million, 2 million raise, and that went pretty well. And then we moved into some other raises. So we're continuing to raise. We're seeing, a little bit of pullback, but we're also seeing a lot of people that, you gotta continue to talk to people and people that are wanting to protect, against other market conditions. So different reasons. And, there's still retail equity that's going in. I think you're seeing even Trevor or Schreier, I'll let you talk a little bit maybe about the, the institutional and others, so you may see a little more pulling back there. And retail is the primary thing right now for a lot of people.
Hey guys, I'm
Yes.
gonna drop off. I gotta
Thanks,
go. pick up my
Sanjay.
daughter. Thank you
Thanks,
everybody for joining, and look forward to meeting.
Thanks. So yes, I mean, in general, LP investors, we are tied up with the stock market, and we see it. So it's taking a lot more education, a lot more conversation to separate out the risk and the emotional bias, right? On the institutional side, expectation changed. Money is available. Everybody, if the project hits around the rate, I mean, if it's a 1980 product or higher, $5 million up to $40-50 million. If it comes close to 5.8 going in cap rate, money is available. Absolutely available, because we are actively talking to direct lenders and also pref check writers and some of the other folks that we're engaging, right? The expectation changed. So there are two kinds of money. You get the pref and you get the JV LP checks. On the pref, they understand what the risks are. They're open to give it to you as long as the project has a breathing room in terms of the cash flow. So what it ties up to everything else, more focus on cash flow than anything else. So before we would have gotten a project coming in 0.8, 0.7 DSCR, work your way up to 1.3, 1.2. That coming in DSCR is not being acceptable anymore. So 0.9 to 1.0 coming in DSCR on a bridge debt, that seems to be the expectation. Or 1.2 coming in no matter what, and then we kind of go. But on the what changed on the prep side, two of the folks that we work with, the expectation of getting a percentage of the cash upfront now, that went down a little bit. On the back end, they're more of an engagement. What I meant to say, if someone says, I'll give you a prep of 14, 7 now, 7 later, we could push the conversation 5 now, 8 later, or 5 now, 9 later, right? And that's what we're seeing. And on the other large JV checks, value add, but not deep value add. And 1980s are becoming a Class C product now. 1990s are the new Class Bs. That's what we say.
Hey, sure. Thanks, Schreier. That's awesome. I saw Liz put in a note, and I was trying to see if Liz wanted to share just what she's seeing. She's been working with us as well. We have a lot of partners in here tonight. We appreciate every one of y'all. Liz?
Yeah. Hey, yeah, thanks, Mike. I think that my experience with investors, I work with a lot of inexperienced investors, and there's a lot of fear, about banks and stocks. And so multifamily is a good opportunity. So that's been my experience right now.
You're right. And even not all lenders are made the same, right? Banks are freaking out. Typically, the folks who doesn't keep the loan in their balance sheets are the issues. So avoid all the lenders who doesn't keep the loans, or not all, majority of them who is not keeping the loan in the balance sheet, because they have to go sell the loan issue, right? And for us, some of the credit union that we work with, we know the balance sheets. They gave us their cash intake. They give us all sorts of other shebang that we go through to stay close to the good quality lenders as you kind of go through.
And yeah, and I'll just add to that, the investors who are more experienced, they want to know who the team is. Like they're like, what's the experience here? What's the debt? Like they want to go deeper into the numbers. And so they know it's still a good opportunity. It's just they want more data, more information. So everybody, just wants more security.
Yep. Thank you. Thanks. Anybody else have something they want to share on that? Brooke, is that a wave or is that a hand up?
No, I was clapping my hands agreeing with Liz because she's spot on. Now investors want everything plus the kitchen sink, because I think they are a little nervous, a little hesitant, even though they are more seasoned, they understand the ebbs and flows, but they are truly digging on the GP team and what their experience is and what they're bringing to the community and what they're, everything. So no, I agree with you, Liz, 110%.
Thank you. Thank you. And again, to any of those, I know Brad shared his calendar in there. Trevor shared his calendar. Set up some appointments with these guys, with these ladies and guys, and meet up with them, get to know Massive better, see what direction you want to go and how we can help you. What other comments, questions, thoughts out there? We're well into happy hour now, so everything's free flow. Anything you want to talk about, anything.
Anything.
I mean, we're talking about health the other day, so it can go any way you guys want. What y'all got?
I was gonna say, I appreciate.
We missed waving at Lad's kid. He was waving at us.
Yes.
And we all missed waving at him. And then Brad Pickett had his dog waving back at him. And maybe I'm the only one that caught that, but I think it's awesome when people can bring their families. One of our team members posted a picture of her kid doing her homework, listening in, and it's never too. Biggest lesson I learned in my life is don't wait to buy real estate and wait. I didn't start till my late 50s, and boy, I wish I'd have started a lot earlier.
Yeah, I would just add to that, when people are worried about the money market, I mean, we look at the dollar, it's a fiat dollar, it's fake, right? I mean, we know that. And that's why you want to put your money into real estate. It's a real building. I mean, you can go up and touch it. And if you don't trust the banks and you're worried about what's going on in the world, that's the perfect time to put your money into actual real estate. And it's a lot safer there than it is in the bank, in my opinion.
Awesome. Yana, you should be able to unmute.
Hi, good evening, everybody. Ayana. That's
Hey, Yana.
my Google name. Ayana. I have a curious question. Probably not relevant to the conversation, but have you ever underwritten with a reduction in rents? I know usually the goal is to increase rents over time, but have you ever faced a situation where you had to underwrite and reduce the rents as opposed to increasing them?
Not directly, indirectly. So we always, multifamily is a revenue game. We must increase revenue. What we do sometimes, we hit the number with higher vacancy. So my net cash flow to me is lower. So it is, in a sense, and if I think about you saying that lower the rent, so your net cash flow becomes smaller. For us, we're saying keep the expectation high, time to set the stage, but assume a lot more vacancy. Assume a lot more people are going to walk away. So your net to you will be smaller. We have done, and some of them, those are deep value add. Like we got to go and strip out almost everybody, then we go back and do it. We have seen some of those, but not a whole lot. But we have seen quite a bit of those. Like once a month, twice a month, they'll show up. And we're actively making an offer on one of those. Yeah.
Thank you.
Thank you. Cody?
Hey guys, just saw what Brad was talking about with the dollar. I was talking to somebody yesterday, and they were actually speaking with her financial advisor when I called, and their financial advisor was telling her to invest in dollars. I'm like, what is he talking about? Why would you invest in dollars? Invest in real estate. So, you know, there's still people out there spewing crap like that, you know, go buy dollars. It's like, I don't know, you'd probably be better off buying pesos, but you know, I don't know.
Look, I mean, everybody should have a balanced approach, right? Unless you're in thick of it, you should not focus on one domain, right? But if, you know, to me, everybody should have a balance, some here, some there, but bias towards what makes sense, bias towards real estate from now to later, all right? So dollar, I mean, it's a tough market. I mean, look, we all want to do the right thing. We are made out of experience. That person probably
Dollars,
sold those stuff before, right?
exactly
So
what
that's
they
all
do,
the same.
they sell dollars.
To a hammer, everything is a nail, right?
That's right.
That's good. I heard someone, he said, go buy gold, go buy silver, that kind of stuff. I mean, look, if you buy knowing there's something happening, I could understand. I hang out with some crazy people. I saw them modeling what they have modeled, and then they went after buying fertilizer stock right after COVID when the Russia kicked in. They made money, but I never thought, why would you buy fertilizer type of stock? Then they explained what they explained. There was an investment hypothesis. So have a hypothesis, look at your portfolio, spread the risk accordingly, and then you go. That's all.
Yeah. I've got some friends, they're doing really well in Bitcoin, so they bought it on leverage, and then they got $1 million leverage call on Bitcoin. Can you imagine? Just vaporized.
I have a guy who sold his house to me. He became tenant. Ramiz and we bought it. So I was like, why are you buying it? Everything looks good. No, I want to move out. That's all he said. He got the workshop and everything else. Ramiz, is that one of the houses with a nice workshop on it? So we bought it. About a year and a half into it, we said we're going to increase the rent. He comes back saying that I cannot pay the rent anymore. I was like dumbfounded. You have everything nice. And what happened? He goes, I was making money in Bitcoin. I sold my house, took the money, and I played and I lost my house. That hurts, man.
Yeah.
That just hurts. So, hey, don't get into something. If you get a hit of it, you cannot survive, right?
Well, this has
No, this
been
is good.
awesome. Thank everybody for coming. Remember.
Hey, Trevor,
Yes, sir.
sorry to interrupt, but I do love to share my thoughts on Bitcoin and gold. My name's Robert, and I want to mention one great book on managing risk that I came across from Nathan Long at Quest Press. It's called The Richest Man in Babylon, and it goes over some key concepts in managing risk. And like the thing that I found really invaluable with the book was not buying things you don't know. And I don't want to steal Trevor's thunder, so I'm going to turn the call over to Trevor. And I want to say thank you all for setting this up.
Yeah, no, thanks for coming, Rick. Good to see you again, Bob.
Rob, it's a good book. And anybody who wants to understand or just listen, get into the market cycle, Howard Marks, CEO, the founder of the Oak Tree Capital, follow him, listen to him. That guy is full of wisdom and it's awesome. So if you want to get technical, go listen to all of his podcasts. And he does memo every quarter. So fantastic, hands down.
Yeah. Get educated and then invest with people you know, like, and trust in real assets, if at all possible.
Mike still frozen or is there?
Can you repeat that last book, Shrar, you just said, who you just mentioned?
Yes, it's Howard Marks, Understanding Market Cycle.
Thank you.
And he also has his podcast. It's a good listen for 30-40 minutes or so. Quite a bit as well.
So again, we got almost 50 people hanging out till 7:30. We appreciate everybody's questions. We love questions. So feel free to ask us any questions. you know, and as I said, reach out to anyone on the massive team. We're more than happy to get to know you better.
I see Daniel on here. Great to have you here, Daniel. I know if we've gotten the meeting set up, I know either Brad or I just to get something set up there with you on a follow through.
Next, Paul still here? Wait, look. Paul left. Okay.
No, I
Paul
think Paul
was
left.
here. He's
Yeah.
hopped off.
Yeah.
Yep.
I see. Maybe Daniel just hopped off when I started talking to him.
I think he's still on here. If you're on
Oh.
here, Daniel, let's connect and set up another call. I'll send you an email.
All right, sounds good. Thank you, everyone. Thank you, Mike. Thank you, Brad. Yeah, I'm looking forward to that.
Yeah, thanks for coming as well. Thanks for showing up, and we'll get connected and work out some plans. And
Brad, how many deals we have in our deal flow tracker? Someone asked me. I don't have that in front of me, you know?
Total, it's like almost 150, but we're looking at
No.
probably, including LOI, under contract, and reviewing, probably 35.
Okay. It's a lot.
yeah, I also see we have Hawaii on here.
Nice.
Sasha, you still on?
Yeah, I'm here.
Hey, how's it going?
Aloha, everybody. Sorry, I can't make the massive capital calls at 4 a.m. my time.
You joined one time. I was so impressed that I don't know what time you woke up, but you joined at 4 o'clock. And I'm sorry, I didn't realize that you're in Hawaii. That was impressive though. What you
Yeah,
have
it's
done.
impressive.
4 o'clock?
It was,
Oh,
I did join from bed, so it's not too impressive.
I guess this is a little better fit for you. But,
Yeah, great information. This is my first one on a Wednesday, and I'm actually at an appointment right now, but I really like your guys' marketing and just your overall, you know, having the big team. Seems you guys are growing a lot, and that's, I think, super integral to keeping other people's investments safe. Me, Chris, I think Chris is on here, and Emma Powell and a few other people are starting a fund as well. So definitely taking notes from you guys and seeing, you know, what other opportunities are out there. And everybody's like, oh, are people still investing in real estate? There's still deals out there. I think people, you know, of course, you need to be more cautious. You need to underwrite more conservatively, but you know, the numbers can't lie, and you can't, unless there's like a super huge like downfall. I mean, you guys, your underwriting, I've been to one of your meetings. It's very spot on.
Yeah, and if you're not following her on Instagram, someday I'm going to be as famous as her. I'm working hard at it.
hey, I don't watch that many LinkedIn videos, but I watch yours. So good job.
I know, I didn't know that LinkedIn wasn't really like a video platform. And so I started posting videos because I'm so used to like Instagram, and I noticed everybody else is posting, you know, actual hard posts. And Trevor, you're really good at it too. So I'm following your lead on LinkedIn.
Yeah. Yeah, we actually had a nice little impromptu session at Best Ever, and I joined her, and it was a lot of fun.
Yeah, if you guys are not going to networking events or conferences, I definitely highly suggest going, even if, you know, you are looking to invest in other people's deals, or maybe, you know, get into a more active position. It's a great place to meet other people, get surrounded by it, and feel comfortable, because it's like anything else, right? Even when I first started investing, nobody in my family invests. I was an engineer, nobody around me invested, and everybody was scared for me. So the more you surround yourself with people that are scared about this and scared about that, it's going to, you know, kind of rub off on you. So thank you, Trevor, for being like one of the only people that I knew at a few conferences. So I felt a little bit more comfortable. But yeah, there's deals that are coming up, and ways that, you know, we could all make money and win in this economy, even though it's, you know, it is what it is.
Yeah, exactly.
I mean, events for someone to be an LP investor, it takes this amount of time spent on this topic and this domain. You just kind of walk in and understand, hey, I know everything. Let's go take a look at it, right? We have common sense understanding, but not detailed enough to make, solid judgment, solid decisions, right? So it takes a lot to be an LP to work. So yes, I 100% agree. Go listen, join in those webinars, understand, follow, and track them out, see what they say, what they do, where they will hang out at, and then time will happen. Just give yourself enough time. All right, Mike, I gotta go break my fast. So you guys enjoy.
Yeah, thanks a
This
lot.
has been
Brad.
awesome.
Great evening. I think
And
we're
again-
ready. I think we're probably at the good time to cut this off tonight. Once next week, we'll be past the fasting period for a lot of people on here. I know Ramiz as well is probably waiting to break fast also. So thank you guys for joining us. I know that makes really long days, so appreciate it.
No, this is good, man. It gets it faster. You're in the middle of it, so it's good.
Gets you to the point without thinking a little bit.
That's right. That's right.
I'll have an extra steak for you.
Hey, oh, thank you. Medium rare, please.
Of course.
Awesome. Well, thanks everybody. Again, make sure you follow us on Facebook, LinkedIn, Instagram, connect with us. Also, every other Tuesday night. So it was this week, but again, our Lady Society does their meetup. You can also connect with their group. They won't let me come. It's women only. But I encourage a lot of ladies to join, and every single person who has sent me a note saying, thank you, this was so awesome. So it's, again, we try to bring value in people's lives more than just investing in real estate. So. Awesome.
All right. Thanks, everybody. Have a good night.
Everybody, good night.
Sasha,
Mahalo.
Sasha, have you connected?
Oh, I'm
with,
here.
have you connected with the Massive Capital Girls Group Society?
No. Is there a link?
I invited you to their Facebook group, but I'll send you a link.
Did you invite me through Facebook?
I did.
Do you
Okay.
have Jasmine's contact as well? Do you have Jasmine's or not? Jasmine's
No.
No.
Zasha, it's Migena. I can help you connect
Okay, there you go, Magana. Thank you.
you.
Hey, did you just join?
I joined at the beginning and then I had a podcast and I joined again.
Oh, okay. Thank you for joining and joining.
I joined 3 times and I was joining on my phone actually
I
as a
know. I kept letting her in. I'm like, where does she keep going?
I was playing hard to get. I said, let me see the notice or something. If I leave, you see, they noticed. So Zasha. Okay, so where is Zasha?
She left already.
I think she just fell out.
I'll send her a
I will
link.
find her. I will find her. I will track her down. How about that?
Okay.
Nice to see you guys, and thank you so much for doing this.
Thank you, Magana.
Got it.
Maybe see you next weekend or next week, whatever the dates, 27th, whatever, 6th, 7th.
You're gonna be in Dallas, right?
I am gonna try to.
This, oh my goodness, for anyone who's there, we are having a reception the 27th. It's gonna be so much fun.
Yeah, that's exciting.
And Trevor, will you be there as well?
Which one is that?
Well, there is a book launch, but the night before, a lot of us are getting together for the
What date is that?
The 27th is a Thursday.
Yeah, I actually won't be. I'm marrying off my daughter that day.
Oh,
the next day.
Oh,
Up in Canada.
congratulations.
Congratulations.
Yeah, my daughter's getting married the 29th up in Canada.
No, congratulations.
Wow. That's awesome.
All righty. Glad you've been really quiet, man. How's it going?
It's going well, yeah, thank you. I was actually paying attention. This was very informative and educational. This is exactly what I was looking for.
Good. Well, I'm glad those Sanjay and Shariah and Brad, they bring some great opportunities and information.
They do for sure, especially like questions like, how can you underwrite a deal with the rents decreasing instead of a projection of a decrease? I'm like, no way he's gonna answer something to that question, and he did. So that surprised me a lot. So
Good. All right, man. Well, thanks. Nice to see you.
you too. Thanks everybody. I really enjoyed it.
Thank you. All right. Good night. Hey,
All right,
Rob.
good
Thank you
night.
for being on.
All right. Hey, I didn't catch it. What's your name? In the pink shirt?
Oh, shit.
Mike,
Yeah, it's
Mike.
Mike Bailey. I don't know why.
multifamily Mike.
Here, I was gonna. Oh, I didn't
Okay.
realize. I didn't realize that it was.
Okay.
There we go. I know I changed the very end.
All right. Pretty good. All right. I'll connect with you on LinkedIn.
Yeah, please do. Please do. Michael Bailey, actually. You'll find me on LinkedIn.
All right. Thanks for everything again.
Thanks a lot, Rob. Great to see you. Great to meet you.
Take
Good
care.
night. Thanks, Trevor.